In this video I'm going to show you how a normal retail investor can invest in hedge funds if they really want to. So we'll start by looking at the problems that you'll face, and then I'll show you some ways around this. Now, the first problem you'll find is hedge funds don't advertise. You'll find it very difficult to actually find hedge funds or find good information on hedge funds unless you're subscribing to a hedge fund publication. You'll also find that they are not on platforms. Again, this is the fact that they're not advertising. You won't find them on Hargreaves Lansdown and you won't find them on Fidelity. You also find that if you're investing direct with a hedge fund, there'll be very high minimum investments, typically around $5 million. You're looking at figures in the millions before hedge funds are interested in you. You also have to be an accredited investor in a lot of jurisdictions to invest directly with the hedge fund provider. So we're talking, to simplify it, you're going to have to be very rich or very sophisticated. Sophisticated is someone who's got financial experience and can be assumed to understand exactly what they're doing and understand the risks that they're taking. One of the first ways that I would suggest you can look into getting into the hedge fund industry is management companies. So instead of buying the hedge fund, you can buy the company that's managing the hedge fund. And instead of getting the returns of the hedge fund, you're getting the fees generated by the hedge fund. These shares are traded on a stock exchange, and I would warn you that they can be very difficult to value and volatile, because when times go bad, people yank their money out of the fund, and that obviously reduces the fees, and some years they don't even get to charge those performance fees because the performance isn't very good. So some examples of these, in London you'll find the Man Group, which is Europe's biggest hedge fund manager. Hasn't been doing very well recently. You may want to look at that company. In the US you've got companies like Oak Tree and Fortress, etc. that manage hedge funds. Oak Tree is a very good company, I would say. It's run by Howard Marks, one of the great investors. And then you've got your private equity companies, people like Apollo, KKR and Carlyle have been trying to get into the hedge fund business. Very big fees, they quite like that. But to say you really want to invest in a hedge fund and you don't meet all the requirements to get into normal hedge funds, i.e. invest directly into the fund, there are ways around this, and the one way I would suggest is exchange traded hedge funds. You've got people like BH Global, which is listed on the stock market, and you've got Bluecrest, has the All Blue Fund and the Blue Trend Fund, which you can find listed. The other way you can kind of invest in a wider range of hedge funds is hedge fund ETFs, but I'm not a fan of these. They are very, very expensive. They tend to be the most expensive class of ETFs, and they underperform the market. So why you would be enthusiastic about investing in a hedge fund ETF, I don't know. The other way that normal investors can get exposure to a sort of hedge fund is through what's called absolute return funds. They share some characteristics with hedge funds, but they are not really hedge funds. But you'll find that they are very expensive. They're more expensive than the average mutual fund by quite a long way, and the average mutual fund is already expensive. You'll also find that these funds are just attempting to generate returns that are always positive. That's what they try and do. They don't always succeed, and you'll find that these typically underperform the market, in part because of their high fees. So I'd be skeptical about these funds, but you may like the idea of always positive returns, even if the returns are lower than what you could get otherwise, which is quite a strange way to think. And if you've decided to invest in hedge funds, I'd like to challenge you slightly and ask why. Why do you want to invest in hedge funds? And do you really know exactly what you're doing? So, firstly, we know that hedge funds are very expensive. You're going to pay a lot of fees. This is probably the most expensive way to get exposure to the market. On average, they outperform, and very depressing study for hedge fund investors comes from Duke University that argues that only 2% of hedge funds justify their fees. Or if you think about that another way, that's a 1 in 50 chance of finding a hedge fund where you're getting value for money. 1 in 50 chance of getting your money's worth. That doesn't seem particularly appealing. That is, of course, if you believe the research, look it up. If you believe the research, you should be worried. I'm going to also just go out there and suggest you probably don't understand them. They are very difficult to understand, and the information is very difficult to get. Just a starter, not all hedge funds are hedged. If you're not aware of that, it suggests that you're maybe not sufficiently sophisticated to invest in hedge funds at the moment, that you require more research. You would think that by calling something a hedge fund, it would mean it's hedged. It doesn't. That's unusual, but it's true. I'd also point out lock-up periods, which are usually a problem when you're investing direct with a hedge fund. This isn't going to happen with the exchange-traded ones. Lock-up period simply means you cannot get access to your money over a certain period. This is good for the hedge fund when they're doing things like short selling and they're working on margin. They don't want money yanked from the fund because that causes huge problems for the running of a hedge fund. And some of them are just simply closed. You just can't invest in them. The famous examples are people like Renaissance Technology and Quantum Fund are just not accepting money. You can't get in. But if you really, really, really insist on investing in hedge funds, these are some things to consider. So you got to look for high watermarks. That means you're not going to be charged performance fees until the returns get over a certain point. Things like clawbacks are also important. That means if the hedge fund loses you money, it charges you less money. The losses are discounted against the future performance fees. And this acts as a disincentive to taking too much risk. The problem with performance fees is a hedge fund could take on massive risk, make massive returns, and charge enormous performance fees. The clawbacks prevent that because it means if the returns go the opposite way, the hedge fund's going to lose lots of money in fees because they can't charge the performance fees for several years to make up for those losses. Also look for evidence of hedging. It's quite difficult to find unless you're reasonably sophisticated, and you also have to have access to the hedge fund's accounts. If hedging's important to you, don't just assume it's there, check. You have to understand the strategies employed, otherwise you're just throwing money around without a good reason. You also have to understand how the fund is correlated with the market. If your intention for investing in a hedge fund is to have something in your portfolio that behaves differently to the portfolio, you can't just assume that it will. You have to actually go out and do your research and understand exactly how it's going to perform relative to your other assets. That's not easy to do, but if you're not going to do it, then I don't understand why you've decided to invest in a hedge fund. And finally, avoid these funds of funds. They're just an extra layer of fees and they will cut down your returns. I don't like these things. So, in general, I would say just avoid them. So that's all. Hopefully this has shown you how you can, if you really want, get exposure into a hedge fund, but also challenged you to say if this is something you really should be doing. So, thank you.